Imagine waking up tomorrow and discovering that you own a bank. Not just a building with marble floors and smiling tellers, but an actual bank. The kind that holds billions of dollars belonging to families, businesses, and governments. Sounds like you've become incredibly rich. After all, banks seem to print money. Every city has one. Every salary passes through one. Every mortgage, business loan, car loan, or credit card somehow traces back to one. But by the end of your very first day as the owner, the excitement begins to fade. You aren't just responsible for a beautiful headquarters anymore. You've inherited thousands of employees, massive cybersecurity systems that must stop hackers every second of the day, billions of dollars in customer deposits, strict government regulations, compliance teams, fraud investigations, lawsuits, branch maintenance, data centers that can never go offline, insurance costs, interest payments, liquidity requirements. And one wrong decision could trigger a bank run capable of destroying decades of work in a matter of hours. Suddenly, owning a bank doesn't feel like winning the lottery. It feels like carrying the weight of an entire country's financial system on your shoulders. Yet despite all of those risks, some banks consistently earn billions of dollars every year while others collapse so spectacularly that governments are forced to step in and rescue them. So how does a bank actually make money? Where does all that profit come from? And why do some banks become financial empires while others disappear almost overnight? Let's find out. If you asked 100 people what a bank does, most would probably give the same answer. It keeps people's money safe. That's true, but it's only a tiny part of the story. A bank isn't simply a giant vault filled with stacks of cash waiting for customers to withdraw them. In reality, that money rarely sits still. The moment someone deposits their paycheck, the bank immediately puts much of that money to work. Think of a bank less like a warehouse and more like an incredibly sophisticated marketplace. On one side are people who have money today but don't need to spend all of it immediately. On the other side are people and businesses that desperately need money now to buy homes, expand factories, purchase equipment, or launch companies. The bank connects those two groups. It borrows from one, it lends to the other, and somewhere in between lies one of the oldest business models in history. Imagine Sarah deposits $10,000 into her savings account. The bank promises to keep her money secure while paying her a small amount of interest each year. But instead of locking all $10,000 inside a vault, the bank lends a large portion of it to David, who wants to buy a car. David pays interest on that loan. Sarah receives interest on her savings. The difference between what David pays and what Sarah earns becomes one of the bank's primary sources of income. That difference is called the net interest margin. And for many traditional banks, it's the engine that powers the entire business. It sounds simple. Borrow cheaply, lend at higher rates, keep the difference, repeat millions of times every single day. But modern banking has evolved far beyond that. Walk into a major international bank today, and lending is only one department inside an enormous financial ecosystem. Banks charge account maintenance fees. They earn transaction fees every time customers use debit or credit cards. They collect mortgage origination fees. Investment banks advise companies during billion-dollar mergers and acquisitions. They underwrite stock market listings. They help governments issue bonds. They manage investment portfolios for wealthy families. They sell insurance products. They offer foreign exchange services for businesses trading across borders. Some even generate revenue through wealth management, private banking, asset management, treasury services, and institutional trading. The result is a business with dozens of income streams flowing simultaneously. That's why the largest banks aren't simply lenders anymore. They're financial supermarkets. Need a mortgage? They can provide one. Need a business loan? No problem. Need retirement planning? They have advisors. Need to transfer millions across continents? They'll handle it. Need to raise billions by listing your company on the stock market? Their investment banking division is already preparing the paperwork. Every service creates another opportunity to earn revenue. And individually, many of those fees seem insignificant. A few dollars here, $20 there, 0.5% on another transaction. But multiply tiny fees across tens of millions of customers making hundreds of millions of transactions every month. And suddenly those small charges become billions of dollars in annual income. Scale is everything. That's why banks fight so aggressively to attract deposits. At first glance, it looks like they're competing to hold your money safely. In reality, deposits are the raw material of their business. The more deposits a bank controls, the more capital it potentially has available to lend, invest, and generate income. This explains why banks advertise high-interest savings accounts, cashback offers, free checking accounts, mobile banking apps, and generous sign-up bonuses. They're not giving away money out of kindness. They're buying access to a larger pool of deposits, because deposits are often one of the cheapest sources of funding available. And the cheaper a bank can obtain money, the more profitable every loan becomes. But this balancing act is far more fragile than it appears. Customers expect to withdraw their money whenever they want. Borrowers, however, may not repay loans for 20 or even 30 years. That means banks constantly perform an extraordinary financial balancing act, making long-term loans while remaining ready to satisfy short-term withdrawals at any moment. Most of the time, the system works almost invisibly. People deposit money, others borrow it. Businesses grow. Families buy homes. The economy keeps moving. But if confidence disappears and too many people demand their money back at once, even a healthy bank can find itself in serious trouble. Because the greatest asset on a bank's balance sheet isn't cash, it's trust. And in banking, trust is worth far more than gold. In the next part, we'll step behind the scenes to uncover the staggering costs of running a modern bank, the risks that can wipe out billions overnight, and why owning one can either make you unimaginably wealthy or bankrupt you faster than almost any other business on earth. If banks were nothing more than giant money printing machines, everyone would want to own one. But behind every dollar of profit is an equally impressive list of expenses, risks, and responsibilities that most people never see. The biggest cost isn't the marble floors or the glass skyscrapers. It's money itself. Remember those deposits customers place into savings accounts? Banks don't get them for free. They pay interest to millions of depositors. When central banks raise interest rates, banks often have to pay customers more to keep their money from moving elsewhere. Overnight, funding becomes more expensive, squeezing profits. Then comes payroll. A large international bank can employ tens of thousands of people. Loan officers, branch managers, software engineers, fraud analysts, compliance officers, investment advisors, cybersecurity specialists, customer support teams, lawyers, economists, accountants, and executives all keep the institution running. Salaries alone can reach billions of dollars every year. Technology has become another enormous expense.